Investors, get ready to take a massive profit on Boyle. We're up 56% since going long, and I believe it's going to go substantially higher. It's not too late to get in on Boyle right now, but we do want to start pulling some profits back and go long heavier in tech, as I'm expecting yields to fall because the global economy is slowing, and this because we haven't had stimulus for a year now. 6%, it's actually hit 10% just now. Total return in 2022 for our high risk strategy, which created a 233% total return in 2021. And it's doing this with less than 4 positions at a time. So, are you ready to triple your money? If so, here's the current trade alert for new investors who are just giving us a try during a test drive. We want you to put $10,000 to work. And right now your trade alert is to buy 85 shares of UVXY. That's your crash insurance if all hell breaks loose. That's your money maker right there. Our growth position in technology is a concentrated bet in Ethereum. Of all the opportunities, this is what we have identified as the single greatest opportunity. I see Ethereum hitting potentially 5,000 to 7,500 this year, and I think it would be a lowball estimate to break past 12,000 in the next 5 years. We're going to go through cycles and problems along the way, but we just had a 55% decline, which is totally normal in this space. I have held through many of those only to see massive returns right after. So the plan is to sell some Boyle soon, not yet, rebalance into Ethereum, and I've got some new inflation plays. It looks like the cost of corn and meat is going to go parabolic this year. Futures markets are already starting to front run that, but right now I just want to stay focused on the cold weather, the conflict with Russia, Ukraine, and keep concentrated in Boyle. And so far that's been a beautiful place. You're going to pick up 213 shares of ETHE. ETHE will outperform Ethereum, the real deal, at Coinbase on the way up. Right now, you want to own ETHE in your stock brokerage account. You don't want to go to Coinbase because you're not going to make as much money. Meanwhile, we're long Boyle. That's 3 times the price of natural gas, an inflationary hedge that's playing off really well. 95 shares. Every morning, I'm going to give you the trade alert, what to do. Most of the time, we don't do anything. But when we need to make an adjustment, you will get that trade alert. This is our high risk growth portfolio. And we generally recommend you put 30% of your money in this system. The other 70% should be in our safe growth strategy, where we're going to be doing the exact opposite. Instead of trying to hit the massive returns of 200% a year, we're going to be targeting more like a 25 to 35% return with a highly diversified global stock portfolio that's still hedged against inflation. All right, so that's your current trade alert. You'll have a copy of that in your email. Okay, so you're watching on the screen, go to your email. It's right there, sent to you every single day. Buy the portfolio, sit back, make some money so you gain confidence to join our program. Here's the key macros to focus on in 2022 with some current events that are going to happen this week and next. So the Russia-Ukraine conflict is still driving energy markets sky high. And I don't think that's about to resolve anytime soon. If anything, it might be getting ready to become aggravated. So this is still looking very good. And the Fed's not going to do anything to cut down energy costs by raising interest rates till March at the earliest. The problem with that forecast is all data is falling rapidly. And so I think that there's, if anything this year, dovish surprises after the market's already priced in 5 rate hikes for 2022. The global economy is slowing down rapidly, and I believe inflation peaks in March. That's the 2-year anniversary of when energy costs, oil went negative. Okay, so likely the highest print, it will be March, and then it will begin to fall into April. This is going to catch the market really off guard because right now politics are driving this super hawkish talk. And again, they're doing it right when I think they know the inflation's already going to fall. So they're not really going to be so aggressive. So the plan is we will soon sell BOIL and double down on Ethereum, and then we'll look at what our new inflationary hedge becomes at that point. We'll look at what's cheap and makes a lot of sense. Hopefully it'll be in RGU at that time. Now, what's really critical, Congress did pass a increased debt ceiling of $2.5 trillion, and now the politicians just need to agree on how to spend it. I believe timing on this is April. House Democrats are saying they want it done before March 1st. Joe Manchin saying they haven't even discussed it since they shot it down in December. And the reason why is they've got to get the inflation coming down before they're going to pass anything. That seems to be the case. So I'm looking for Build Back Better to pass April. There you go. Build Back Better likely passes in April as inflation cools off. Now, if inflation starts to cool off sooner, then we can upgrade that forecast to be sooner. So what does this leave investors with as investment options? If you buy the dollar or any other currency, well, you're really in a problem because governments are devaluing their currencies at 5 to 10% a year. And this is just not going to change anytime soon. There's no plans to balance the budget in any government anywhere that's meaningful. So cash will lose its purchasing power. Bonds are still garbage because the 30-year treasury needs to rise to 2.5 to 3%, and the CPI, which is at 7%, needs to fall to 3%. That'll be your magic moment to go long treasuries, which is one of my favorite positions. It makes my job a lot easier to have low volatility in our portfolio with a simple stock treasury position. But the problem is the treasury market needs to sell off at least another 25, maybe 35%, and inflation needs to cool off simultaneously for that to become a logical investment once again. So we've made investors a lot of money in that market. We've been out since they started printing trillions of dollars and suppressing rates. So we need to let this reset, and I believe this could happen by early 2023. And that's based on some inflation expectations and estimates by Goldman Sachs that believes the CPI will hit 3%. In fact, I think they think 2.4 by end of year. That might be a little bit courageous prediction or hopeful. But by 2023, I do think the rate of change of inflation will be dropping quite rapidly. So we'll watch the data because that's really critical to how these markets play out. So investors really have no other logical option. We want to have the right mixture of stocks, crypto, and commodities with the downside crash insurance hedge. Watch these continue to melt up until there's a better alternative. That alternative will eventually become the US Treasury market. But again, it's got a lot of pain before it hits that magic moment where the CPI and the interest rates collide and make sense. And I think we're about a year off from that. Now, what could I be wrong with? How would I change my opinion on how to invest? If you give me a really strong labor market, I believe that will speed up the timeline of creating the bond crash, and that's going to be the key market threat. So good news is they're hinting we may have 150,000 jobs come Friday, which is sad. They need to be getting like 500,000. So right now, this is estimated at 150,000, but there's whispers coming through that, wow, it might be even worse. So we'll see. And the other most important critical thing is that the producer price index and the CPI, they need to slow down how fast they're rising into March and then start to fall into April. If that doesn't happen, then the Fed will have to follow through with all these hawkish threats, which would mean hiking interest rates, doing quantitative tightening, which would reduce government spending. All kinds of problems are going to break loose if that occurs. So we're watching it like a hawk. And the good news is the data is supporting that we are facing a significant slowdown because the fiscal impulse is fading. And because they won't pass the Build Back Better bill, likely until that happens, the inflationary impulse is going to slow down and then fall. And again, the last big stimulus was February of last year. The next big CPI update that's important is February 12th. If it's cooler, expect Ethereum and tech to melt up. In fact, they're already starting to melt up. So perhaps there's some insiders who know what that print will look like ahead of time. Now, it's critical you watch our live webinar every Monday, Wednesday, Friday to be ready for the trade alert and to keep a close eye on all this data where I break it down for you so you know exactly what you need to do. People are wondering how high can BOIL go? Depending on the conflict, yeah. I mean, if Russia really cuts off Europe, I mean, the recent high was almost 100, and today we're at 46. So I'm more interested in the timeline to get out, which will be before the end of February. Stephen says, when you go long treasuries, will you use a leveraged ETF? You betcha, TMF. Yeah, we want to get all that free money leveraged into the portfolio as possible. Rose says, how about our triple Q? Yeah, that's where I think you're going to get a, that's where I think we're going to hit the next big win after we pull off BOIL, is in the NASDAQ and Ethereum specifically, because I think rates are going to either stabilize or fall. And again, if anything goes wrong, we're protected against a outright stock crash with UVXY. We're over 10%. That's going to probably fall if we're right and the market melts up, but that's fine because we're making more money on the long side than our hedge. There's been a lot of volatility, a lot of head fakes. So I'm happy to just let that depreciate on its own at this point. And again, last 2 Marches ago, that is, in 2020, when there's a black swan event and the stock market fell 35% in a month, UVXY went up 1,100%. So if you had 10% in UVXY and the other 90% of your portfolio went to zero, at the peak panic, you had a 10% gain. And let's say you never sold your UVXY. Well, your other positions rocket right back up when the government came in and printed trillions of dollars. So it just does a great job having it in there, and you don't necessarily have to touch it all that much. Okay, now a little advertisement to upgrade your free trial. There's 3 spots available per day at special pricing if you call Dean Gallagher at 505-322-7515. And what's critical is you're going to unlock the membership area. You're going to get the safe growth strategy and the high risk strategy. And that's really important because in general, what we want you to do is combine the 2 strategies together and every month rebalance. That way you're pulling profits off the higher risk strategy and putting them into the safe growth strategy when we're winning on the high risk system. And alternatively, when we do have a drawdown in the high risk, you can pull money out of the safe growth and rebalance. So the combo makes a lot of sense. Now, the safe growth is going to put you into every major corporation globally from Asia, Europe, and North America, plus a whole bunch of other inflationary hedges. And it's going to get Bitcoin into your portfolio. Whereas high risk is just looking at the single hottest investments that are available and really sniping those opportunities. Okay, very good. Let's go ahead and jump into some data. Okay, reverse repo remains elevated, $1.6 trillion. Now, we're not worried about collapse of the bond market until this is drawn down below $1 trillion and probably down below 700 billion. So just stubbornly staying up there. Let's see, Rose is asking about EDC. That's 3 times emerging markets. That'll probably rip higher dramatically once Build Back Better is passed, because that's when I think we're going to have the next leg up in rates. So emerging markets tends to follow rates like the European market, whereas the tech positions like the opposite, low rates. But with that said, emerging markets are cheap. Asia's, specifically China's, kicking some ass. And I do think that will be, over the course of 5 years, your best performing index, specifically because I believe rates will rise substantially in this market. ESR says markets are melting up into the close. Yes, and we own all of those hot markets between the 2 portfolios. Okay, in this chart, we are comparing NRGU to BOIL. And so we made a pivot, and BOIL's outperforming 3-1. So very good. Boyle is doing a great job to hedge us against essentially inflation and what impact that can have on markets. Now here's a look at the NASDAQ in the candlestick, NRGU in green, and interest rates in yellow. In general, what we want you to note is that typically if interest rates are flat or down, the NASDAQ goes up. But alternatively, if interest rates are rising, energy costs go up. And so that's why we have these important energy hedges built into all portfolios. Now, what do we think the next move is? I believe rates will either stay flat or fall, that this move right here has been overdone. So if I zoom in on that move, we can see rates rose 23% on the triple T. And so again, that's just the long end. Perhaps a lot of the pain the market's been facing has been from the front end, the 2-year, which has gone parabolic, several 100% higher in the last year. So we're not looking at that interest rate in this, but rather the long end. Okay, in this chart, we're looking at emerging markets, interest rates in yellow, and then we have two components of emerging markets, FXI and MCHI, two Chinese specific indexes. So you can see that correlation to rates. So just very powerful correlation there. Now, if we zoom in a little bit, what I want to note is we're getting a big rebound in the Chinese ETFs relative to emerging markets. And that's where the pain for emerging markets has come from China popping various bubbles in their economy, specifically Evergrande being broken up currently. Okay, Russell 2000 was our most bearish chart to be frightened of, still is, but we're starting to get a bid. So we're going to keep a close eye on that. Russell 2000 really needs to recover here. So this remains the most troublesome chart, absolutely. And a good reason to keep that UVXY at a decent level currently. Now, with that said, there's still some garbage in the Russell 2000 that's been manipulated by Reddit crowd, AMC, GameStop. So we do need to take that with a grain of salt. Here we're looking at the European index. We're along with safe growth, hanging in there. Most likely needs the Build Back Better bill to make its next leg higher. So in my opinion, the next move are flat or lower rates, and Ethereum and the NASDAQ or the triple Q take off, and perhaps the SPY, which would be UPRO for our members. And then as the inflation slows, the government's going to sneak in there and spend a bunch of money and drive rates back up. And that's when you'll see the outperformance in energy, EFO, and emerging markets once again. Okay, this chart, we're looking at DXY. This surprised me, jumping to 97.4 as the Chinese currency devalued a tiny bit finally. Today it's falling, and what do you got? You got a melt up in stocks and crypto. My forecast is likely the dollar, especially after the Build Back Better bill's passed, falls towards 90, and that's when I will do some significant changes to the portfolio. So we're a long ways away from that. The profits we can potentially make from 96 down to 90 are astronomical with how we're currently positioned. So we'll keep watching that. But there you go. Probably the biggest reason you're seeing stocks go up so much right here, this drop in the dollar. Turkish lira, just making sure nothing's breaking over there in Turkey. Normally we wouldn't follow that, but when a decent sized country starts to go into hyperinflation, we do need to pay attention. And it looks like they have stabilized their currency. So that's good. And again, just a warning sign. Here's the Chinese yuan, finally weakening a tiny smidgen. So nothing to be concerned about there. Lumber futures, which had been falling, had a big jump back up of 16%, so starting to rebound. This is what we've been potentially using as a leading indicator to predict the price of oil and potentially Natural gas, it leads oil so far in this recent trend by about 2 months. So we'll keep a close eye on it. And again, I expect to sell BOIL, or at least start trimming it down into the month end. And then we'll see what the next inflationary hedge makes sense, which makes the most sense. Okay, copper futures still trading flat, no real signal here in general, in an uptrend looking strong. Okay, now this one is telling us the inflation is starting to subside. This is the Baltic Dry Index. So we've got inventories at very high levels. We've got a crash in the cost of houses. We've got all sorts of things of this nature. Retail sales fell 2.3%. So we're starting to see that slowdown come in. Now in this chart, we're comparing the price of oil to interest rates. And we're starting to see that divergence again. Now, you know, for a long time, even when I was wrong, like specifically in the summer, at least in the short term, I was very stubborn that oil must go higher. And we had the rates going lower. We had the lumber futures crashing. I kept making us hold on to that bloody NRGU. And we had a lot of drawdown, but at the end of the day, we did hit a huge home run by sticking to that path. Now I think we're coming towards the opposite. I think oil is going to top out, have a pullback, and then with the Build Back Better bill, have the next leg higher. So carefully watching oil and rates, lumber, you know, all of these markets to get a feel for what's coming through. But my best guess is we're near a peak in oil. That BOIL is going to peak out by March, and then we're going to need to wait patiently for the next opportunity to enter. Okay, so here are 3 different government bond yields: the 2-year, the 10-year, and the 30-year. And that 2-year sitting at 1.18 is what I believe has caused all the volatility through December and early January. So this needs to top out. This has got to stop going up. It's now pricing in 5 rate hikes. So if all the data really starts to slow down, I believe that can fall and be very, very bullish for how we're positioned, because it would be a dovish surprise. Now, again, you go past the Build Back Better bill, and these rates are going to go right back up, because that bill will be extremely, extremely inflationary if passed in its full legislation. So we'll see what exactly they do get through. Kevin says, can we play oil to go down? Yeah, by owning Ethereum and the NASDAQ. That's exactly what we're doing. Okay, so here's a look at some of these tech giants. We've got Tesla, Nvidia, Google, Amazon, Microsoft, Apple, just all kicking ass, taking names. And I believe this will continue after that sharp sell-off we've had. In the other part of the S&P 500, I'm now focused on 3 companies. Berkshire Hathaway, doing phenomenal with the inflationary environment. JP Morgan, actually taking a little bit of a whack. And then we've got Bank of America keeping up with JP Morgan. In general, long term, I expect value to outperform growth over the next cycle because of high levels of inflation, suppression of interest rates, and massive fiscal spending globally. It's only in the short term that I'm expecting the growth sector to greatly outperform. JD says, do you think today's melt up is another head fake? No, I don't. Because I think the inflation is going to subside and we're going to get dovish surprises. But if the inflation doesn't subside, it's going to be doomsday quite quickly here. But we won't know till March and April to make a concrete bet on that, and nobody will. So that's really okay. Now in Asia, we're looking at Taiwan Semiconductors, Alibaba, Tencent, huge bid there. This has been selling off for a year. It looks like it's bottoming. Probably with the Build Back Better passage, that's when this is going to really scream and outperform everything. And that's our largest position at safe growth is Asia, just much better valuations. compared to the rest of the world. Now in Europe, we are specifically watching Toyota for signals. And boy, is this one strong company. Really no weakness to be alerted. So of all the charts, the only thing that really keeps me up at night would be the 2-year sitting at 1.18, signaling 5 rate hikes. And then the Russell 2000 way below, way below that trend line it had. So those are the two things that make me wonder. But other than that, everything looks very, very bullish from here. Here's Exxon. We're going to have earnings from them, so it'll be interesting to follow this week. Now, if you look at futures markets into the future, you can see an inverted yield curve. But if you're looking at real rates right now, the only part of the yield curve that has inverted is the 20-year over the 30-year, which I don't make much of. As far as the 2-year over the 10-year, this is flattening. That's not what we want. But again, it's a long ways off. It's a long ways off from going negative. Even if it did go negative, that would signal 16 months to recession. So no yield curve inversion to freak out over currently. Okay, here are these markets in the bond market that we follow. We've got JNK, LQD, TLT. All of them have taken a little bit of a beat down here, but nothing too dramatic. And so we can see JNK down 4%, TLT down 4%, and LQD down 6%. But in the shorter data, we're starting to see these stabilize, and it looks like the pain is over. So that's all bullish for the way we're positioned. This chart, we're comparing Tesla to Ethereum, expecting these two to be correlated. Tesla's jumping up. I believe Ethereum's going to close this gap soon. So very good setup for Ethereum here, assuming I'm right and rates stay flat or fall. Gold to Bitcoin. It's time to go big on gold or buy the dip on Bitcoin. I believe it's time to buy the dip on Bitcoin, of course, and with our current forecast. If I was to get very deflationary and the dollar were to hit 90 DXY, I'd be interested in essentially EUO, TMF, and UVXY. Those would be the 3 products. Today, none of those make a lot of sense. Dollar's super strong. Treasuries are probably in for another 30 to 50% decline before they hit maximum yield and correlate to inflation. And then again, UVXY is what we currently use to hedge our portfolio exclusively. And so yeah, we got to be patient on those plays. All right, in this we're looking at some alternative energy plays. We got copper, tan, uranium, and rare earth metals, all of which getting a bid here after being beat up. In crypto world, we're seeing a nice jump over the 7-day mark. Ethereum really jumping up after having a lot more drawdown than its peers. In fact, it had more drawdown than some of the smaller altcoins, which is unusual. There's a lot of people leveraged into Ethereum, staking Ethereum, all sorts of stuff. So that unwind was quite brutal, but looks like it's really stabilized and getting ready for the next leg up. So very, very bullish on both Bitcoin and Ethereum. Less so on their competition because Ethereum's about to roll out proof of stake by this summer, which will remove a substantial advantage that Cardano, Solana, Polkadot, and Avalanche currently have. Okay, gold to copper ratio. I believe we're headed towards a 2002 to 2006 type of cycle, and we want to be betting big on these energy products. So that's exactly what we're doing, and you can just get a feel for how out of control and how long this could last and how sharp these moves higher could be. This we're looking at the futures probabilities of rate hikes, and boy, this keeps going up. There's now a 15% probability of a 50 basis point rate hike in March by the Fed. That's not priced into the market. It's pricing in a bunch of little 25 jumps, not a 50. And this keeps going up. So that 2 years, why it keeps going up, that needs to start to fall here soon. So we'll keep a close eye on it. Here's a look at the yield curve. And so I'll show you what they want it to look like, and then we can see how it looks. So the black line back in October of 2020, right before Trump passed $1 trillion stimulus, Biden passed a $2 trillion stimulus. You can see the stimulus really screwed up the bond market, made it go from a ramp, which they want, the banks want, to a something like a hill, and even inverted over here. And it's made the 2 year go skyrocketing. So this is telling us the market thinks the Fed's going to have to hike rates to cool off inflation, and it's going to kill growth. And that's what this is telling us. So we'll see if this starts to shapen up the right way as things start to change. Now, there we go. So last week we had this front month of the VIX above all the other months, which is a setup you need to have immediate huge profits in UVXY. We're no longer in that setup, and it looks like people are starting to cover their hedge and buy the dip. And there's a record amount of hedging currently in the market. So I think it's highly unlikely we get the big crash right now, unless the inflation is just much worse than everyone's anticipating and catches the market off guard, which I'm not going to say is impossible. The December print was far higher than anyone predicted. Steven says, when you say treasuries are likely to go down 30%, you mean TMF, not the underlying, right? No, TMF's leveraged. So I think we're going to go from 2 to 2.5 to 3 on that long end. So that is 25% or more decline to hit a peak. And that would match us up to the inflation that we're hoping it'll get down to. Now, if the inflation stays at 4 or 5%, then we've got a 60% correction, and the markets absolutely couldn't. So that's why you got to realize the inflation has to slow down, or the whole financial system is going to go down without question. And it's going to be all forced into action by politics and the Federal Reserve. So yeah, we'll just have to watch this data as it comes in. Okay, so the rate of change of cases has fallen off a cliff. Expect the jobs to start coming back online now. I was anticipating a weak print for December and January due to people calling in sick, but I think that's about to come to an end. So expect people to be hungry for work and to get back out there in probably late February, early March. I think that's when we start to see job growth resume once again. Not a ton of debt being issued by Janet this week. She's filled up the coffer. I think she's got like 700 billion now. So that's good as far as not wanting rates to rise. This is the data that needs to slow down. So we need the producer price index to stop going up. We need the CPI to slow down. It doesn't have to stop going up for the market to be happy, in my opinion. It just has to slow down the rate of change. So we had 4 to 4.6, a 0.6 jump. Then it slowed down from October to November, the 0.3 jump. Then it sped back up to 5.5 in December. So that has to be less than a point. So we need this to come in below 6.1 for the way we're positioned to really pay out. So yeah, that's what I'm anticipating, is it a sub 6 inflation. If it's way above that, we're probably going to get another sell-off in bonds and another jump in energy and another dunk in growth, which would be your NASDAQ and your Ethereum. I am out of the cannabis stock position. Yeah, I'm not tracking it at all anymore. What a thud. But yeah, just there's other ways to, that was supposed to be an inflation hedge for us, and it just did not do the job. Okay, jobless claims still showing signs of weakness, elevated levels, labor force not rising like it was early. Okay, that would be very That would make interest rates rise if labor force was going up, but it's pretty much flat. Credit's rising, that's good. Consumer credit's rising, so that's good for us to remain long stocks. Retail sales did fall 1.9. One print's not the end of the world, but you get a couple of those, and yields will fall. Consumer spending is still highly elevated. Balance of trade still highly negative. These are key components of our prediction for the dollar going down. The balance of trade highly negative, and the growth of debt highly positive. Those combined weaken the dollar over time. China's PMI, now the growth engine of the world, China, we like to look at its PMI, its imports, 2.4 trillion, second highest print of all time, and then 3.4 trillion, highest print of all time. So there's no reason to think the whole global economy is going to crash. We're just expecting it to slow down and for rates to fall, not rise. Okay, balance sheet keeps growing despite all this hawkish talk. So they're printing money while talking about destroying money. So, we're going to keep printing money and then suddenly destroy a bunch of, at least that's what they're saying they'll do. Okay, the European balance sheet continues to grow. Now on the news feed, Dennis says, how long would you expect to hold Ethereum? For the next 5 years, most likely. We will adjust the position size over time, but we don't go all in on one asset. We always have a mixture of growth and value, because we might get the big picture right, but timing is really freaking hard. So we don't want to be believing we can get the timing perfectly, even though we get the big picture right. So yeah, most likely we will be increasing Ethereum, and then once the Build Back Better bill's passed, decreasing, but not completely exiting. Okay, we had a 10% decline in house prices in December. Okay, wait, this just updated my newsfeed. White House says Russia has been surging troops into Belarus. Fed Bostic says possibility that the Fed will cause a recession is relatively far off. This is looking at a inverted yield curve, looking at futures prices on bonds of the 5 and 30. Bostic warning the January payrolls may be lower than prior months. We had Jen Psaki warning the same thing. So it might be pretty ugly, we will see. This is just a note from Joe Manchin to get a feel for timing of Build Back Better, and there's nothing happening there right now. BlackRock's Russ Kostrick said he likes cash and the dollar as hedges more than the government bonds, which are increasingly risky in a rising rate environment. I agree with that, but I like UVXY better than cash. The 60-40 Bedrock portfolio of stocks and bonds set for the worst decline since 2020 in March, 5.4% loss in January. And look, we're up in both portfolios. A whole bunch of ruckus happening over Joe Rogan, Elon Musk just going to town, commenting on this. So just entertainment value on that. European inflation surprise index has gone vertical. Oil and natural gas prices better stop moving higher, otherwise the U.S. line will look the same. And I agree, those costs need to come down, or otherwise all hell is going to break loose in markets, and that's why we have that hedge there. Current discount on Grayscale Trust relative to what they own. Bitcoin, you can buy Bitcoin 28% off with GBTC and 23% off with ETHE. Killer deal. Unless you're using your Ethereum to go to Aave, take out a loan and go yield farm, which is what we do in our private equity thing, you're better off owning ETHE. If you know how to do what we do in our private equity, then sure, you're better off owning the real deal. But yeah, this discount highly unlikely to last for much longer, if I'm right on rates flatlining or falling because of a slowing inflationary environment. Whales have been gobbling up this volatility. So it's the big wallets have grown. Retail has been essentially liquidated. by the tune of billions of dollars. So I think the bottom's in here. GDP forecasts keep getting cut by Atlanta Fed, Goldman Sachs, everybody. It's very clear the economy is slowing down, which means rates fall and most likely growth assets get the bid because bonds are still not attractive. Here's a sentiment indicator signaling perhaps bottoms in on stocks. Super high level of hedging currently. Typically, you don't get the big crashes when everybody's insured. BlackRock says stocks haven't dropped enough for dip buying yet. Goldman Sachs and Morgan Stanley came out with the same piece. JP Morgan saying buy the dip. Now, oftentimes these guys say the opposite of what they're doing, and zero hedge jokes. Translation, BlackRock hasn't bought enough stocks yet. Morgan Stanley, we remain sellers of rallies and of the belief that the volatility and intraday swings we are seeing are a classic bear market action. Fair value remains closer to 4,000 on the S&P 500. This is a reason why we need to pay more attention to inflation. It's been obvious in the economy for a year, but now it's hurting the Democrats' budget. That, who cares about anything until they can't pass their budget? Now it's a problem. So if the inflation doesn't come down, expect the Fed to act at no matter what cost, which would be markets falling due to tightening. Chai Girl says, I will say this again, the energy crisis in Europe will not be contained on that continent. Africa is starting to see the effects. North America will not be immune. So we're keeping a close eye on that energy, as you guys know. Here's a look at the hedging, record level of put options, and a lot of it by retail. So yeah, most likely we're not getting the big crash right now. Lynn Alden says, in the long run, the cost of malinvestment is stagflation, not deflation. That's what governments are very good at. Fed calls this week, JP Morgan, Bank of America, Morgan Stanley, Deutsche Bank, 4 to 7 hikes this year. So that's what the market's positioning for, but yet it may come out to be less, again, if the inflation slows down. So that's what we're going to be really, really focused on here. Here's a look at the red line is our strategic petroleum reserve. So we held through that. When they dumped that, oil went down a bit, only to skyrocket back up. Stupid move. Lynn Alden says, despite the major outperformance of the energy sector lately, I think this move is just getting started. When we look out 5 years, it'll have bumps along the way. Completely agree. I think we're about to have one of those bumps. Here's a look at the growth of energy use globally. Just mind-boggling. The growth from the 50s of 20,000 terawatts to 160,000 today, and most of it being driven by oil and coal and natural gas. Here's a look at the whale balances growing on crypto. Okay, very good. And we did this where we left off last week, so very good. Ed says, is this a good time for the triple Q? Yep, and Ethereum. Okay, very good. So now we're going to go to exactly how we're positioned in the market, which again is only for paid members. So if you're on a free trial, you're about to get kicked out of the video until you call Dean, take advantage of the special offer, and upgrade. Call Dean now at 505-322-7515.